Today will be a quick video. I decided to do this video based on what happened with the FOMC statement and then the press conference that followed. And it's really interesting how Fed Chair Powell came out with, the statement being a little bit more dovish, and then immediately, like knowing what would happen to the market, because the market was anticipating, and then immediately shift to quite hawkish in the press conference, and then pushing everything way back down, which is really interesting. So the Powell's trap. So the market was expecting some pivot signs. Either maybe they'll come in less than 75 basis point, and then giving a future more hopes in terms of rate cuts or slow down on pacing of rate hikes. And the market was really counting on that. They were really searching for any signs of pivot to try to rally on that based on what we've seen this year. And with that disparity, there's a Fed statement with the 75 basis point rate hike that at some point that they will they think that it will be appropriate to slow down the pace of rate hikes. So within that half an hour of the statement release and the press conference, we saw what we would have expected: dollar being down, stocks and precious metals commodities were going up, and yields were also coming down. And once we hit the press conference, Powell was given a few questions, right? He was being asked, like, okay, what does this mean? Like, are we expecting some slowdown, and what kind of indicators are you looking for? And then there were a few comments that really pushed. It was on the later half of the press conference that really pushed the whole market to the other side, where he stated that we still have some ways to go. The ultimate rate hike, the ultimate level of rates will be higher than expected, and also it's still too early to think about pausing rate hikes. So it's really interesting in terms of the contrast between what was said in the statement that accompanied with the rate hike and then the press conference that followed. And the idea, again, what we're thinking is they'll raise rates more than what the market is expected, and also maintain it for longer, because again, the idea, the kind of purpose of all of this is really to try to weaken everyone else, while U.S. is still able to handle it. And with that idea in mind, everything else is something that they're willing to sacrifice, including obviously bond prices and equity prices. And that means until that pivot happens, like, don't be so looking for it, don't be too excited for it to happen. Until that actually happens, the direction is really continue to hold cash, short equities, or something that works against the tightening of monetary policy and tightening of liquidity. And another thing, just kind of finish off this video, the companies, what we've seen when it comes to earnings report is some companies are starting to cut spending. Obviously payroll being a big part. Some are laying off workers as well. As mentioned before, with the rate hikes continue higher and the economy is not doing in a good shape, what that means is company profits will be reduced, and that also builds into what I mentioned before with the EPS being downgraded, coming lower than expected. But the problem is expenses aren't really coming down. And so we're seeing revenues falls because, again, the economy is not in good shape, things are becoming more expensive, consumers are not having as much disposable income to buy stuff. And, U.S. majority of the economy is consumption. And with wages pressure continue to maintain and march higher with the lack of labor, again, the tight labor market, this results in a perfect storm for equity value, because there's less profits coming in, right? And then there's less free cash flow. That means there will be less free cash flow for buybacks. And what happens is what we've seen in the past, again, I've talked about this before, where previous equity value, a lot of it has been fueled with buybacks. And if the buybacks aren't there still, and some of these these growth companies who have been able to, support their equity value with, buybacks, if they still can't turn a profit, if they continue to be in the loss, then the equity value has a long way to go. So, and investors are starting to favor companies who are cutting spending. So when we see these earnings report and we're seeing some companies announcing that they'll be cutting spending, we actually see the share value go up after that report. And that's because some investors are looking for companies who are actively trying to cut spending. What the problem is that this is risky because there's still more pain to come with, the Fed still yet to really do a pivot. And the lower risk is to deleverage with, government trying to, with central banks, tightening. Obviously, we're seeing some central banks are slowing down their pace, but they've yet to really start easing yet. They're just slowing down their pace of tightening. And we're seeing companies are trying to cut down their debt as well, because otherwise, with rates remaining this high, they can't service it. The lower risk is to, deleverage instead of, chasing these, certain equities. Thanks for watching.